What is up? This is the Working Investor. In this video, we're going to do a four-headed battle between four different strategies of income funds that have income funds on single stocks. Some of them pay you weekly, some of them pay you monthly, and many of them have leverage. This four-header battle is going to be GraniteShares versus Roundhill versus YieldMax versus Granite Shares. If this is what you're looking for, please stick around. As always, nothing is financial, tax, legal, or any sort of advice. This is purely for fun and entertainment purposes only. I'm going to drop a video at some point that I'm working on, and I call my elements of ingredients that you see in funds that are stronger. There are strengths and weaknesses with every single type of strategy. And I truly believe for myself, this is my own personal opinion, there's no such thing as a good fund or a bad fund in general. I feel like every different type of income fund that do option trading have strengths and weaknesses. And it's your job to look at the strengths and weaknesses and see how that fits into your portfolio, your risk strategy, and then you decide, what kind of allocation you want to make. As we go through this video, you're going to see different types of fund using different types of strategies, and you're going to see different strengths and weaknesses. And then when I drop the other video, which may be a little bit technical, but I promise you it's going to give you a lot of knowledge that I have, and I will do it as a public service for you as a starting point to look into things further. With that said, when I say GraniteShares, I'm talking specifically the GraniteShares weekly pay and growth and income ETFs. As you can see here, they have four of them, but it looks like they did an SEC publication. They filed for a whole bunch more single stocks coming out. Just briefly, this strategy is a leverage fund that they have flexibility with the leverage of 1.05x to 1.5x. They could titrate that up and down. And so there is leverage, and they have income because they write options on 50% of their position. And basically, they leave half the position uncapped so you don't get whipsawed. So that's their strategy. And we'll pit that against the very popular Roundhill weekly pay trademark ETF that uses a static 1.2x or 120% leverage. And they also pay distributions, and they pretty much do swap agreements, and they just give you the difference of the proceeds, what they earned, or if they didn't earn any money, they may not give you any. And they have tons of single stocks, as you can see over here. And we're pitting those two against the good old-fashioned YieldMax single stock cover call ETF, trademark YieldMax. And they do cover calls. They used to do synthetic cover calls. They do synthetic cover calls, and they do call credit spreads and all kinds of stuff. They're considered now the OG, I guess, from the option high yield dividend space on single stocks. And we'll pit those three against the contender of Granite Shares. This is just, they have many different funds. This is an example of one of their single stock funds of coin. So basically, it's a 2x leverage. Not 1.2 or not 1.25 or 1.05 to 1.5. It's 2x leverage, a lot of leverage, and they do puts as opposed to calls that GraniteShares does or YieldMax does, or no options whatsoever that Roundhill does. And the two examples we're going to look at is going to be Tesla and all its correlated assets that from these four different companies, respectively, and NVIDIA. Why am I looking at these two as samples? Because as you can see in the past 6 months, the past few months, NVIDIA is up a lot. So it's been having a bull run. And Tesla has been having a bear market. So this gives me a sample of a bull market and bear market and how these funds may behave in the future or may not. Past performance is not indicative of future gains. Let's start off with the bad. As you can see here, I'm using Tesla as the benchmark, and we're using the quad header Tesla versus TSYY from Granite Shares versus TSII from GraniteShares versus TSW from Roundhill. And we're using the most contemporary fund that came out. I wish I had a bigger timeline. I'm not cherry picking. I'm doing June 4th because that's about when TSII came out approximately. And you're going to see the benchmark of Tesla in this time period of June 4th till August. Wherever we are in August, it's down 0.72%. So anything greater than this, we'll see, will be relative to this. In other words, I can't even speak. Tesla from YieldMax down, total return 1.63%, more than double down than Tesla. Shame on you, YieldMax. A cover call strategy in a down market should outperform, but no, maybe you could see the volatility. Perhaps it was the whipsaw that whipped Tesla out, and it did twice as bad in total returns as Tesla. Let's move over to TSYY, the Granite Shares 2x leverage with puts. And they put out of the money puts, and it's off-putting because they're down 4.24%, more than 4 times worse than the underlying in this period of time. Shame on you, Granite Shares. And then there is TSII from RecShares. And in this same period of time, they did 4 or 5 times better than Tesla. Instead of being down 0.72%, they're up in total return 4.28%. Way to go, because they have 50% uncapped. And now you've all been waiting for Roundhill, where they don't have any option overlay. They just have a pure 1.2x leverage with swap agreements, and you kind of swapped out your income for losses, and they're down 2.21%. And that's what happens. There's nothing to keep it up. There's no income overlay. You're paying for an expense ratio, around the same expense ratio, approximately 1% for all of them, and you're not getting any option overlay. How lazy are they? This is a down market example. Let's go look at a raging bull market. So we're looking at NVIDIA, and that's going to be our benchmark against NVD from YieldMax, against NVYY from the Granite Shares, against NVII from RecShares, against NVDW from Roundhill. Let's look at the benchmark, and the timeline is very important. I'm not cherry picking the timeline. I'm doing max time that I could find from the most contemporary fund. Unfortunately, we only have under 3 months worth of data from May 28th to August 9th. So in this time period, NVIDIA is up 35.5%. Okay. NVD from YieldMax failed to capture the total return of the underlying. That's not surprising, because when you have a cover call ETF and you write that at the money, you're gonna miss out on the whipsaw. The whipsaw is gonna kill you. Even with the call credit spreads, you can't expect to get 100% of the underlying. If you get 70, 80%, you're still good. So I would say, relatively speaking, the way it's behaving with the cover call strategy in this fund, I wouldn't say that it's did a horrible job. But of course, if you're can you get good dividends and overperform, not underperform, at least match NVIDIA or do better NVIDIA? Can you have your cake and eat it too? And the answer may be yes. But let's first go to the put strategy. So the put strategy, the puts were not breached, and the 2x leverage fund did pretty well, but it underperformed NVIDIA. Shame on you for underperforming, but that's what happens with put spreads. It's off-putting. NVII, remember NVII, they're leaving 50% uncapped, and they're up 40.43%. So you got your cake and you ate it too. You got income, you got weekly income, and you outperformed the underlier by about 5% on total returns. Now, our favorite for a lot of people who like this fund, NVDW, it is a leverage fund, swap agreements, bam, 42.36 total return. So yes, in an up market, it looks like the no dividend, no option overlay, pure leverage fund did 42.36%. But if you want a leverage fund, there are many leverage funds out there. There's 1.5, there's 2, there's NVDL from Granite Shares that does 2x leverage NVIDIA if you're uber bullish and you want capital efficiency. So they're not doing any options, they're just giving you some of your money back. It reminds me of XPay. But then on a down market, as we just saw, TSW underperformed. So I like, personally, my opinion, my risk tolerance, not financial advice. I have no business giving financial advice to anybody. This is my personal take and my rationale. I like the rec share play. It works with my style. It gives me that good alpha, but it also gives me a little bit of like the best of both worlds. It gives me option overlay on a sideways market, on a down market. I don't have to worry too bad about whipsaw. So that's why for me that's a winner, because I'm looking at both sides of the market, not just one-dimensional one side of market. Like I said, I'm working on this video over here to go over the ingredients to educate the investors out there with my knowledge, what I know. And you are free to scrutinize and critique me as much as you like, because I leave my ego at the door and I'm here to be a smarter and better trader every day. And if you have something to teach me, I'm willing to learn and change my style if it makes sense. Come join me in my Discord if you'd like. It's completely free. I will never ask you for money. If somebody's asking you for money, they're spamming you, please report it to me and report it to the Discord. This is your Working Investor over and out. I hope you guys have a wonderful trading week. Be well. All the best.